And actually, Joel Greenblatt made an observation that if, someone was starting out with $100,000 to invest or $1 million to invest or $10,000 to invest, they could look in all kinds of nooks and crannies that most other people couldn't. Merger arbitrage, junk bonds, just different places you can go to some crevices that a lot of other people cannot go into simply because you couldn't put much capital to work. And if you are really good at that, I mean, if you started with $1 million and you were really good at what you were doing, you wouldn't be sitting with $1 million after 5 or 10 years. It might be several $1 million. And as you increase the capital under management, your ability to keep focused on those nooks and crannies changes because you can't be making $100,000 bets on a $10, $20 million portfolio. You can do it on a $1 million portfolio. And so you would naturally move up. So you might start off looking at things where you could put 100,000 to work. And after a few years, you might be looking at things where you might put $1 million to work, which means that 100,000 space has vacuum now. So investing has an interesting phenomena where the lower end spaces continue to become new fertile hunting grounds for new entrants because the incumbent players have moved on. The successful ones have moved on. The unsuccessful ones we don't care about. And so it's almost an evergreen business from that point of view. It's also a business where the little guy has an advantage over the big guy. So the little guy can go all kinds of places. When Berkshire and Buffett made their bet on the Japanese conglomerates, the trading companies, it was Mickey Mouse for Warren Buffett. I mean, it took him a year to put the money to work. And he did it just, for the hell of it, but didn't really move the needle much for Berkshire Hathaway. But for somebody else, that could move the needle a lot. I mean, they could deliver some spectacular returns on a portfolio, even a sizable portfolio by doing that.